Well, first of all, it's interesting, especially in light of your comments earlier talking about the pullback that we've had thus far and that we had another one like this earlier in the year. And we've had in total 16 pullbacks since the beginning of this recovery that have been 6% or more. So certainly nothing about, simply the magnitude of this one tells us really anything. And the interesting thing about this one, though, is that it's been highly correlated with the bond market, right? So if before investors kind of had that safe haven, we haven't seen that this year. The Barclays aggregate is solidly down, whether you look from the beginning of the year or from the beginning of the stock rout. In terms of where the market is headed, certainly if you look to credit, and I'm certainly a credit watcher, right? We're not seeing the stress there. We're seeing certainly also very rich valuations, but we're seeing companies even in the lowest part of that market in terms of quality being able to generate enough cash to service their debt, and defaults are still tracking, solidly below 2%. So we're certainly not seeing any sort of stress fundamentally.
Jeremy, you got the big job at UBS. So are you good enough to do December 31st, or would you want to kick it off till June 30th?
I'll take the extra time. Thank you, Jim.
You'll take. Will we be higher by June? You think we'll make this back up and maybe go to new highs by then, or is this more problematic? Maybe the end of some secular move that they do end.
Bull markets do end, but we don't think that the bull market ends between now and the middle of next year. We think stock prices will be higher. Markets tend to overreact in both directions. So I think that, look, in the third quarter of this year, the S&P 500 was up almost 8% on a total return basis, despite the fact that trade tensions were escalating. And so I think the markets got a little bit too complacent. And then we had both a rate shock, and then we got the implementation of tariffs and the start of earnings season. We heard from companies that they're starting to see slowdowns in pockets of global growth, and some of their cost pressures are rising. So it's not surprised that we're seeing a little bit of a negative narrative in the short term, but I think we've overreacted to the downside with this almost 10% pullback. I mean, valuations for the S&P 500 today are back to February 2016 levels on a price to earnings basis. So I think we got a little bit complacent at the end of September, and now we've overshot to the downside.
When you point out that the market's not reacting to the 22% gain in S&P earnings, when you point that out, by definition, that means valuations have come down, because if earnings are up 22% and the stock prices come down, then you've wrung out some of that.
Well, or earnings bailed out an expensive market is the other way to look at it, right? Or the market anticipated that these earnings would be here. And I wonder what gets us
bailed out right now. I kind of feel like it's failed.
I do wonder what gets us out of this little bit of a cycle, though, where it's, sure, we know corporate profits are strong. We need to see that they're going to remain okay next year, right? Yes, we know interest rates are going up. We need to make sure they're not going to go up in such a way that hurts valuations so much. I mean, Oksana, do you see us getting any resolution of these things? On the one hand, look, Treasury yields have pulled back a little bit. Oil prices are down. Maybe those are kind of pressure release valves in the short term.
It could be. And look, we are still very much in the low rate environment, even with everything the Fed has done. And the Fed has done it, obviously, as a reaction to a strong economic backdrop, and they're going to continue to do it. Nothing about what the Fed has done thus far has been a surprise for the markets, right? If you look back over the last several years, or a few years that the Fed has been on this normalization path, every time when they've guided for a certain amount of hikes, they've followed through. So there's nothing about this that should really be spooking markets. But certainly, as the Fed and the ECB now start to come out of their extraordinarily accommodative mode, that's going to have impact on just the amount of money sloshing around the system, and that absolutely will have an impact on valuations across the board, bonds and perhaps stocks as well. But nothing about current rates is prohibitive in terms of company profitability.
Oksana, what is Jeremy mentioned trade tensions, but other than that, I haven't heard much concern from either one of you about tariffs. There's been a number of companies that have come out recently with earnings, and they're blaming misses on increasing impact of tariffs. Big deal? No deal? How do you view the tariff situation right now?
Can certainly evolve to be a big deal. Probably not a big deal thus far, although certainly I think some of this apprehension we're seeing is trying to figure out which way is this going to evolve. But perhaps more importantly, when we think about rates and what implications they have for portfolios, because certainly they are the backbone of everything that happens in this market, what's going to drive them more so perhaps even than any of this noise is just the simple dynamics of supply-demand, right? The fact that we have an exploding, or a growing, I should say, deficit, and the fact that the largest demand provider for the treasuries is pulling out of the market, as is, China is buying less treasuries, Japan is buying less treasuries, Russia, not a major demand contributor, but certainly has reduced its allocation to treasuries as well. Banks are being deregulated, so holding less treasuries. So there's just significantly less demand. And that is what likely will continue to push rates higher and have impact on portfolios, perhaps more so than some of this noise.